Let's welcome on board then Neeraj Gambhir from Axis Bank and talk about what he's made of the Fed's move and the India impact that it's going to have. Neeraj, great to have you on the show. Thank you so much for taking the time out. Neeraj, the Fed has now hiked by 25 bips and indicated that it's going to be limiting itself to no hikes going forward, but no cuts in this calendar year either. How do you read into this move and the commentary, including what we heard from Janet Yellen?
So, first of all, I think the Fed has not said that they will not be doing any further hikes. I think they have tweaked the language to say that there is some potential for further adjustments. Now, what that adjustment is, I think most of the market is interpreting that to be maybe another 25 basis point hike in the month of May. Most importantly, I think the market is pricing in roughly 75 basis points rate cuts through the rest of this calendar year, whereas Chair Powell was very clear that the committee does not see a case for a rate cut this year. So there is a big divergence there between what the Fed has talked or the chairman has talked in his speech versus what the market is currently discounting. So I think somewhere along the line, the market is worried that all the events that have happened in the US, including the banking sector crisis, is going to have a downstream effect on the economy. And there is going to be sort of some kind of a lending tightening, and that is going to impact both the inflation as well as growth, and that will push the Fed to sort of start cutting rates as early as maybe July or latest by September. So that's what the market is currently pricing in.
All right. Going down the line, given that the Reserve Bank as well will be meeting in the next 2 weeks, Neeraj, inflation is, as of now, that doesn't seem to be abating either. So what do you believe the Reserve Bank is going to do?
I think if you just keep aside what happened in US in the last 2 weeks and maybe in Europe, I think if you just look at the domestic factors, we have CPI, which is coming in stronger than what was anticipated. Our growth is holding up well, rupee is holding up well. So I think there is a case for Reserve Bank to think of maybe a 25 basis point rate hike in the April policy. And then thereafter turn a little bit of data dependent in terms of how the inflation goes and how the growth goes. Importantly, we have seen a significant drawdown of liquidity in the system. And currently the system liquidity is in deficit, but this is also the month of March. So I do expect that, in some senses, a shift towards saying that whatever we have to do on the liquidity front has at least been achieved. And from here onwards, the system liquidity will continue to maybe somewhere in the neutral zone.
There are also enough suggestions, Neeraj, indicating that India is kind of decoupled. And, this was the case even back during the 2008 crisis. But that was, not to be, at least not back then. How decoupled do you think we are currently when it comes to our banking system as opposed to what's happening currently across the globe?
So decoupling in terms of our linkages with the rest of the world, I think that's not the case. We continue to have strong, linkage with the rest of the world in terms of capital flows, in terms of our on trade. So I'm not a great buyer of the decoupling theory per se. I do believe that the structure of financial system in India is very, very different from what US has and what the European economies have. Particularly US, there are like a large number of banks. There are 4,000, 5,000 banks that they have, and a lot of them are sort of small regional banks. Indian banking system is, on the other hand, very small number of banks, relatively speaking, and very tightly regulated. So I think in that sense, our financial system has in the past seen lesser impact of these events than probably what countries like US and maybe countries in Europe have seen. But it's hard to say that we are completely decoupled. There is always an impact on the capital flows, and there is always an impact on the sentiment.
Your outlook then, as we're seeing interest rates on the rise, in terms of where you see the bond yields headed, and as a treasury team as well, for Axis, what's the outlook in terms of, ensuring that you're not badly hit by losses?
So I think we continue to run a fairly well-managed portfolio in that sense. Our view on the bond yields, and the bond yields in India have been actually fairly range-bound as compared to what's happened in the West. We have been 7/4 to 7/2 zone for the last, I would say, about 6 months. We think that it'll still be very range-bound as we get into the next fiscal year and as the government starts its borrowing program. And There could be some upward bias. I think we could hit, go towards 760 or thereabouts, but it's still be a very, very range-bound bond market. And I think the fact that we are likely to see one rate hike and after that there is a potential for pause in India as well, I think that will keep the bond market well supported.
There's a large risk of M2M losses in the Indian banking sector?
I mean, there is some data out there which Reserve Bank has put out on their financial sector, report, which is basically the stability report that they put out. The cumulative losses in that report as of September was roughly 1 lakh crore. My guess is, and this is my calculation basically, which says that this is roughly about 5% of the cumulative capital the banking system has. So actually, in our case, yes, there is holdings in the HTM portfolio by the banking system, but they are well constrained. They are about 25% of the portfolio. And the fact that bond yields have actually not moved as much as they have moved in the Western world, that has also limited the losses. And thirdly, I think the banking system in India is also well capitalized at this point in time. So I think there is no contagion or no effect of that nature that I see here.
All right, Neeraj, thank you for taking time out and giving us a perspective as to what the overall macroeconomic scenario plays out back home, as well as the implications of the Fed hike.